Hello and welcome to Startup Street, and we've got a full house today. I'm Arundhati Ramnan and with me is Shruti Mishra and Ritu Singh. These are the top headlines from the startup world. B2B manufacturing service unicorn Zetwork acquires US-based industrial manufacturing firm Unimax for a total deal size of $39 million and is planning to clock more than $1 billion of revenue for the financial year ending 2023.
Former Flipkart executive Ranjit Boyanapalli's early-stage startup Flash raises $5.8 million in seed funding led by Global Founders Capital, White Venture Capital, Zenal Growth, Soma Capital, Emphasis Ventures and Peer Capital. The company will use the fresh funds for product development, hiring and global expansion.
Women-focused upskilling platform Hunar Online receives an undisclosed capital from actor Shilpa Shetty. The startup has also onboarded Shilpa as its brand ambassador of the startup.
Bootstrap restaurant chain Burma and Tea Room raises over $2 million in a seed funding round led by Negan Capital. The company plans on opening 8 new outlets in the next 15 months, taking the total to 14 outlets.
Urban Company gives stock options worth 5.2 crore rupees to about 500 of its service partners across India under its partner stock option plan. 30% of the PSOP recipients were women partners from its beauty and wellness vertical. Urban Company looks to increase partner stock option plans to 150 crore rupees in the next 5 to 7 years.
Google and YouTube announced a $13.2 million grant to the International Fact-Checking Network to launch a new global fact-check fund. The new fund will open in early 2023 and will support the network of 135 fact-checking organizations from 65 countries covering over 80 languages.
Binance announces its first license in East Asia with the acquisition of Japan's officially regulated Sakura exchange Bitcoin. Binance says that the Japanese market will play a key role in the future of cryptocurrency adoption.
Twitter's Blue Verified service is scheduled to roll out on Friday, but only on Apple's iOS mobile software, the information reported. As Twitter plans to launch the subscription offering via an update to Twitter's iOS app, it needs Apple's approval as part of the standard app review process, the report said, adding that the company would update its Android app later. Those are the headlines we are tracking for you this evening. Agtech and dairy startup MooFarm that focuses on bridging the technology gap to empower marginalized dairy farmers has raised $13 million in its Series A funding round. Avishkar Capital, the impact investing arm of the Avishkar Group, led the round in partnership with Aditya Birla Ventures and Axel Partners, along with existing investors Rockstart Agri-Food, Navis Ventures, including venture debt from Alteria Capital as well. Now, to talk to us about the road ahead at MooFarm, joining me now is its co-founder and CTO, Jitesh Arora. Jitesh, also joining us is Sushma Kaushik, partner at Avishkar Capital. Jitesh and Sushma, welcome to Startup Street. And let me come to you, Jitesh, first. Before we talk about the fundraise, if you could talk to me about MooFarm's model. You have a full-stack platform that offers dairy as a service. Tell me how you're empowering dairy farmers and what kind of efficiency and increase in yield and profits have you been able to provide them?
Sure. First of all, thank you so much for having me here, Team CNBC. And coming to what we do here at MooFarm is we are building for dairy farmers of India, the 100 million dairy farmers of India, with a single core objective of increasing farmers' profitability. How we're doing that is whatever dairy farmers need in today's world to build, to produce milk and whatever pre-farm gate services they require. Mainly 3 kinds of services. One is cattle induction. They need good cattle to produce good milk. They need good feed induction to produce good quality milk, and eventually advisory services. So we're building with dairy farmers in all 3 aspects with the objective to increase their profit.
Yeah. All right. Coming to you, you now, Sushma, MooFarm is in an interesting space. Have you interacted with some of the farmers they cater to, and what kind of challenges are they facing? Any feedback that you've got?
Sure. No, thanks so much for having us today. So yes, absolutely. We've been interacting with the farmers for a while. At Avishkar Capital, we've been investing in microfinance and dairy businesses for some time now. So we deeply understand the kind of challenges that the small and marginalized dairy farmer faces. of the 100 million dairy farmers that are around, 85% of these are small and marginalized farmers
Yes.
who typically face a lot of problems because of the lack of transparency in pricing, in buying cattle, quality of feed, and so on. And hence, this is why we see this as a big opportunity when Farms is trying to disrupt the way the services to the dairy farmers is rendered.
Okay. Jitesh, coming back to you, you plan to use the fresh investment to further scale operations in Rajasthan, Punjab and Haryana and expand to Madhya Pradesh and Maharashtra. If you could elaborate on your expansion plans, what's the current reach and how soon do you plan to roll out your expansion?
Sure. So we are currently very widely spread in Haryana, Punjab and Rajasthan. And as you rightly said, we are planning to expand in MP and Maharashtra very soon as well. And also, the expansion plans includes consolidating all of these services. So we have 3 different business units which are running parallelly, but with the new fundraise and Avishkar, likes of Avishkar Capital and Access supporting us, we are planning to create this new vision of dairy ecosystem called DAS, where we club all of these services and tag our farmers as Move Farm farmers, where we can maybe help them sell milk at a better price as well. And the next 1.5 years is just going to go into that. Okay. And making sure these farmers are getting good prices for their milk and increasing their profitability.
All right. Jitesh, the Move Farm app is vernacular and allows farm data to be kept in one place. If you could elaborate on its offerings and how do you plan to further strengthen the technology? Any new offerings in the pipeline?
Sure. So currently we have very basic business services like they can order feed and cattle from our app directly. Moving forward, we're also launching a herd management tool, which will help them manage all of their farm activities, which will help us gather their data as well, where we can predict for them what they should be doing in the coming months, where should they be investing so that they get their maximum profits out of their farms.
All right, Jitesh.
So I think that's something new that we're getting in the application.
Okay, one more question to you before I go to Sushma. Let's talk about business growth numbers. What is the revenue model? How are you making money and how soon do you hope to turn profitable?
Yeah, so in terms of numbers, we're doing pretty well. Last financial year, we did 55 crores of revenue. This year, we're planning to clock around 125 crores. And next year, we're planning to do 300 plus crores.
Yes.
Revenue model is basically we sell cattle and we help farmers induct cattle and feed. And we earn a basic commission, a margin in those business areas. The advisory services is completely free. Is we do advisory to build trust so that farmers can start buying cattle and feed from us. So yeah, that's the revenue model.
All right. Sushma, coming back to you, like you mentioned, one of the focus areas for Avishkar Capital is sustainable agriculture. In fact, Move Farm has built a connected commerce platform and aims to increase income for 100 million dairy farmers in India. What is the potential you see in this space and how do you see technology changing the dairy farming industry?
So actually, the dairy industry itself is a $162 billion industry growing at a CAGR of about 15%. The allied activities like feed and the cattle trading itself is about $56 billion. The feed is about $23 billion. So as you can see, it's a very, very big industry. And so when things have not kept pace with the kind of growth that we are seeing in the industry, it's clearly ripe for disruption. Also, the dairy technology has really progressed quite a bit in terms of the science that has gone behind it.
Yes.
Unfortunately, it hasn't yet reached these small farmers. And we believe that a platform like Move Farms can help all the science and technology go into dairy, which can significantly add value, not only in the hands of the farmers, but also to the industry at large.
All right, we've completely run out of time. But Sushma, many thanks for joining us on Startup Street. And Jitesh, of course, wish you the very best in achieving your target of 300 crore rupees in revenue by FY24. Many thanks, both of you, for joining us on Startup Street today.
Thank you so much.
On that note, Cashify, a re-commerce platform for used electronics, has outlined an aggressive retail expansion strategy. The startup, which currently has 170 offline stores, plans to expand to 250 by March of next year. This with an aim to reach 120% annual growth. It also wants to be present in another 30 cities by the end of this year. The company in June had raised about $90 million and was backed by the likes of New Quest Capital Partners and Process. Joining us now to discuss the company's expansion plan and its road to profitability is Nakul Kumar, the co-founder of Cashify. And with me also my colleague Shruti Mishra. Nakul, Thank you so much for joining us on the show today. Cashify is currently undertaking an aggressive retail expansion strategy. You hit 100 stores in March of this year. Now you want to add 250 stores. You want to have 250 stores by the end of March of 2023 and be present in about 100 cities by the end of this year. So where are you on that front, and how are you funding this expansion drive?
So first of all, thank you for having me on the show. I think one of the great learnings we have had this year is that what people see, people buy. And we are creating refurbished phones as a new category in the market. So we knew that we need people to experience what a quality refurbished phone looks like. And because it's not just any other refurbished being sold from an unorganized retailer. So what really helped is when people walk into the store, they experience a second-hand phone. And these stores not just act as a selling point, but also as a service center to the network. So as we sell more and more refurbished phones, we need to cater to the servicing needs of these phones. And hence, this store acts both as a service center as well as a retail point where people can sell and buy their old phone. So, and we have seen very exciting growth for this year, and we remain to be very bullish in retail. I think 250 is a good number to be in March, but our aim is to be almost 400 by end of next year. So by December, we should be targeting at 400 stores across 100 cities.
All right, so 400 stores across 100 cities. If you could quickly tell us, you're also focusing heavily on tier 2 cities. Can you tell us the kind of traction you've seen in these cities versus your stores in tier 1 cities? What are the footfalls you expect to see from tier 2 cities?
So as an experiment, we started in metro cities, and you also have to realize that even in metro cities, there are a tier 2, tier 3 population available. So not just from where they're coming from income levels and exposure. Worked well for us, and as we kept expanding to tier 2, tier 3, the success amplified. Actually, there's such a huge need in smaller cities because there's no option available.
Okay.
And hence, our success in these cities are gaining more traction.
Okay. Hi, Nakul. This is Shruti quickly coming in. I understand 40% of your business is being driven via online channels and 60% via retail. Now, how do you view this revenue mix going forward? How are you merging the two channels to drive more growth?
So I think you mixed up retail and so it's B2B versus B2C.
Yes.
But offline retail contributes about 10 to 12% of our total top line. And I think it will remain on that because our online presence is also increasing continuously. And I think as a percentage of our total business, retail has a very strong connect and will remain stable. It will not degrow. So
Okay.
as you see a lot of internet companies saying that offline is not important to them. It is a very critical part for us. And also, we don't differentiate between an offline customer and online customer. For us, every customer is important, and
Okay.
we want to be present anywhere where they are.
All right. Nakul, also, you're looking to turn profitable by FY24. You recently pushed your timeline to turn profitable in a bid to focus on growth. And this isn't the first time. So what's the road to profitability looking like? Are you on track to hit your target?
Yeah, we are all on target. I think the money is being spent to expand, and the business model is looking good. We are operationally profit. I think it's just the cost of putting up new stores. We are doing a lot of R&D at the back end, where how do we refurbish, how do we grade, how do we make it more consumer friendly. I think those investments are being taken care into it, and hence we have extended our runway to profitability.
All right, Nakul, we're completely out of time, but thank you so much for joining us on the show today, and we wish you all the best going forward.
Thank you very much.
On that note, it is time for us to head into a short break. But coming up next, the Reserve Bank of India's new rules on digital lending guidelines are set to come into effect tomorrow. But how ready are fintech players, and what will this mean for the digital lending ecosystem? We find out on the other side. Stay tuned.
Welcome back to Startup Street. Now, it is the dawn of a new era in the fintech space with the Reserve Bank of India's new rules on digital lending guidelines kicking in starting tomorrow. These guidelines cover areas across lending processes, disclosures, technology and data gathering by regulated entities, their digital lending applications and lending service providers which are engaged by these. Now, the norms bar the presence of third-party accounts in the flow of lending. They prevent automatic increase in credit limits without the consent of the borrower and specific consent-based use of borrower data, among other changes. So how ready is the system to comply with these rules, and what will this mean for the digital lending ecosystem? To discuss that and a lot more, joining me now are Sugandh Saxena, the CEO of the Fintech Association for Consumer Empowerment of FACE, and Anurag Jain, the founder and executive director at Credex, and also the founding member of the Digital Lender Association of India. Sugandh and both of you, thank you very much for being here, Anurag and Sugandh. Sugandh, let me start with you. How ready is the fintech ecosystem now that the November 30th deadline ends today?
Actually, nobody was waiting for 30th November. I think, most of our members have gone live long before, I think many of them in September itself and many during the course of the time. So I guess we can be very sure that industry is very well ready and have already implemented most of the changes, right? So there's no reason to worry on that front.
Well, Anurag, do you have any reason to worry? Is everything in place? Nobody is going to fall out of line?
No, I think the short answer would be that we are prepared. As Sugandh rightly mentioned, we were not waiting for the 30th deadline. I think most of the companies have already aligned their flows with that. And, with the new guidelines coming in as the guardrails for the industry, I think that's, it's like a blessing in disguise. At least now there are, ways and, methods in which you can actually run your business rather than, being worried about whether it is a gray area or not. So things are now more black and white rather than being in the gray area.
But, Anurag, say in DLAI's 80-plus membership, how many would you say would have to change their business models? Were there drastic adjustments that had to be made to comply?
So I think close to 40-45% of our membership base are companies who are not banks or NBFCs. So they are basically the fintechs, and in the digital lending parlance would be termed as LSPs and ancillary services. So I think there were a certain level of adjustments that were to be made in the workflows for some of these companies. But having said that, I don't think there's any existential problem for any of our members. Everybody is running their business. They are now geared up to look at the growth in the next couple of quarters. At least there's that level of certainty which is there, which was maybe missing when there was a lot of gray area.
Well, I'll come back to those missing certainties in just a bit, Anurag. But Sugandh, in the short term, what happens, to comply with these new guidelines? Would the operational costs go up? Will those be passed on to consumers? How would this work?
Compliance, I guess, is not something which has to be seen from the perspective of cost. I think non-compliance is much higher cost, which I am sure everybody is aware of. So there's no feedback from the industry as such about the cost aspect of it. Of course, there was a lot of reworking which was required. But the positive side, as Anurag said, is much, much more than the flip side of it. There would be some short-term pains, of course. But if you look at industry data, which we released earlier this week, you can see the growth momentum is actually accelerating, right? So what we saw, the growth numbers in Q1 is actually increased more in Q2, which essentially tells you that, even in the quarter where there was a lot to be done, what people have ensured is that customers servicing and customer credit is just not a stop, or there's no let up on that, and which is very positive trend that despite whatever else was required, people have continued on the growth trajectory. And I don't see any particular, these are very tech enabled system, once you do it, it's done. So it's more about effort rather than, I would say, cost per se.
All right, so more about effort. But Anurag, like you said, the grey area of not being a regulated entity and almost being equated to illegal, at least that goes away with these guidelines kicking in. But that aside, you as a representative body for fintechs, for digital lenders, would have made some representations to the regulator. We understand in relation to these rules. Is everything, all of the rules something that fintech lenders are comfortable with? Would you have liked to see some changes that have not been incorporated?
Definitely, there were certain asks from the regulator perspective, but I think rolling out all of these things in one go is not maybe possible from an overall fintech ecosystem perspective, and which is where we are still looking at some of these things, which is where, for example, the FLDG guidelines, where we are obviously expecting some more clarity coming in from the regulator in due course, and which is where there are a couple of other items as well, which for which we had sent out the representation, and which is where we are waiting for them to come back. But overall, I would say, I think from an industry perspective, we do welcome the guidelines. I think this is showing us some sort of a direction. And from the fintech's perspective, I think the broader goal remains the same, right? I mean, so you were basically required to go from A to B. Now you're being asked to go through C rather than going through a certain other path. So I think the end objective remains the same. It's just maybe some sort of operational changes that have to be made, but otherwise overall objective as a fintech body remains the same, that you have to bolster financial inclusion, you have to ensure that credit reaches to the right in the remotest corners of the country through the financial institutions who are there to provide it. I think that goal still remains the same.
Absolutely. Well, absolutely. Like you said, NBFCs existed because banks couldn't fill certain requirements, and fintechs are filling in the loopholes left by both banks and NBFCs. So there is that requirement. And like you said, FLDG is an area where we need some more clarity from the regulator. Unfortunately, we've run out of time. So both Sugandh and Anurag, thank you very much for discussing these new digital lending guidelines that are set to kick in starting tomorrow. So we'll see how the face of the digital lending ecosystem changes. Thank you both very much for being with us here. All right, on that note, we're going to wrap up this edition of Startup Street, but stay with us. More news and updates coming up on the other side of this break.